Hi everyone. In this video, I'm going to go over a comprehensive problem using cost volume profit analysis. Prior to this, I taught you individual totals, figuring out break even, contribution margin per unit. So this particular problem, I've started it for you. The reason being is that if I did not, the video would be extremely long. So I'm trying to keep you motivated, especially students that accounting is not your concentration. All right, so let's get right into it. Here's the problem. It is saying that Marcus Allen is evaluating a business opportunity to sell premium car wax at vintage car shows. The wax is sold in 64-ounce tubs, so we're going to figure out a lot of times the cost per tub. Marcus can buy the premium wax at wholesale costs of $29 per tub. That's going to be our variable costs. He plans to sell the premium wax for $84 per tub. That's our selling price. He estimates fixed costs such as travel costs, booth rental costs, and lodging to be $880 per show. That will be our fixed cost. Okay, so let's look at the board. So I've already started this problem, and over here is how you will figure the contribution margin per unit. You're going to take the selling price per unit minus your variable cost per unit, and that will give you your contribution margin per unit. The first question is asking, determine the number of tubs Marcus must sell to break even. It's looking for units. So you're going to take the fixed cost and you're going to divide that by the contribution margin per unit. Remember, we derived that our first analysis. So we take 880, we divide that by 55, and that gives us 16 tubs. Remember, that is not a dollar figure. Next question. Assume that the company wants to earn a profit of $1,320 per show. So this helps management if they want to figure out how many tubs do I need to sell in order to get a target net income of $1,320. Now your textbook just calls it operating income, but know it that that's their target income. All right, how do you derive that? So you're going to take fixed costs, you will add in your target operating income, that will give you your total. Then you'll divide that by the contribution margin per unit. When you do, you're going to get 40 tubs. So 40 tubs is what they need to sell in order to get this target net income. Next question, determine the sales volume in dollars to earn the target profit. Okay, so you figured out that in this particular problem that it's 40 tubs in order to get this target net income. So now you're going to take the 40 times the 84, which is selling price, and that's going to give you the sales dollars, 3,360. Okay, the next part I'm going to do with you, here's why you really haven't seen this before. So the next problem is asking, use the question, using the contribution margin format, prepare a condensed income statement. So it's looking for an income statement for A and B. Okay, so what are the sales dollars at the target level? We figured that over here. So that is 3, and this is a dollar figure, 3,360. Remember in the lab, put your commas in, minus the variable costs. The variable costs, just so you know, let me kind of put this over here. The variable costs are, we had to sell 40 tubs. So we're going to go back in, what was our variable cost per unit? That is $29. So our variable costs are, again, a dollar figure, 1,160. We will subtract that, and that will give us our contribution margin. We subtract it, we're going to get 2,200. Next, we're just going to take our fixed costs. What are our fixed costs? Those are 880. We will subtract that. So our operating income at that target net income is what we said, $1,320. Okay? All right, so next part of the problem. Determine the margin of safety. Okay, so the margin of safety in dollars, determine the margin of safety. The margin of safety in dollars is going to be here. You're going to take your actual or expected, in this case we're going to use the expected, minus the break-even in sales dollars, and that will give us the dollars. The units I have over here, the units we're going to take the sales at the target level minus the sales at break-even level, and that will give us the margin of safety in units. The percentage, we're going to take the margin of safety in dollars, we're going to divide that by the sales at the target level, and that will give us the percentage. Okay? All right, so grab my next sheet. Okay, so the margin of safety in dollars. Let's do the margin of safety in units first. Okay, so margin of safety in units, I'm going to go over here. I'm going to put the 40. So remember where we got the 40. We got that right over here. So the sales at the target level are 40. The sales at the break-even level we got up here. So the margin of safety in units that we need to sell are 24. Okay? All right, so that's units. So my answer is 24 in units. Okay, margin of safety in dollars. I'm going to take my margin of safety in dollars is the actual expected. All right, so the target that we want is 3,360. We will subtract minus the break-even in sales dollars. Okay, so the break-even in sales dollars is 1,344. Okay, we'll subtract that, and that will give us 2,016. All right, so how do you get the margin of safety, the break-even at sales dollars? You are going to take the 16 tubs, okay? 16 tubs, and you will multiply it by the selling price, 84. So 16 times 84, let me just show you that so you look at your notes. 16 times 84 will give you 1,344. You will take the difference, so the margin of safety in dollars, your answer is 2,016. Okay, all right, so now the margin of safety in percent. You are going to take the margin of safety in dollars, which is here, 2016, and then you're going to divide it by the sales at the target level, which is 3,360. Okay, when you do that, you get a decimal at first, 0.60, convert that to a percent, 60%. Okay, and that's how you get the margin of safety in percentage. Okay, all right, so you're going to see a similar problem in the lab. Get in there and get it done.